Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we're going to explore how a company's competitive advantage is reflected in its financial statements. Understanding this connection helps us see not just the numbers, but the story behind them, how a business stands out in the market and maintains its position. We'll look at key financial reports and learn to identify the signs of strength and resilience that come from having a clear edge over competitors. This foundation will guide us through the details in the upcoming slides. Competitive advantage is often talked about in broad, sometimes vague terms like brand strength, culture, or innovation. But to really understand it, we need to look at something concrete, the financial results a company produces over time. A real and sustainable competitive advantage shows up in a company's ability to consistently deliver returns that exceed its cost of capital. This means the company earns more than what it costs to fund the business, and these superior outcomes show clearly in financial statements. If a company can't do this, any supposed advantage is likely temporary or not genuine. This discussion will focus on recognizing competitive advantage by analyzing financial data, explaining how business leaders and investors can identify true advantages, and highlighting common mistakes companies make when they think they have an edge that isn't actually there. We'll also look at practical examples and discuss both the benefits and the limits of using financial analysis to assess competitive positioning. A company truly has a competitive advantage when it can consistently generate higher returns on invested capital than its competitors, maintain those returns over time, and withstand pressures from competitors that might otherwise reduce profitability. It's important to be clear that competitive advantage isn't just about fast revenue growth, being the biggest in the market, having a well-known brand without actual pricing power, or making short-term profits due to favorable conditions. From the perspective of creating real shareholder value, competitive advantage only exists when a company earns economic profits, meaning its returns exceed the opportunity cost of capital. Because economic profits are reflected in financial outcomes, this means competitive advantage must be evident in the company's financial statements. This approach helps us move beyond abstract ideas like brand or market position and focus on measurable economic performance. Return on invested capital, or ROIC, is a crucial measure because it shows how well a company turns the capital it invests into profits. In simple terms, it's calculated by dividing net operating profit after tax by invested capital. A company that holds a competitive advantage consistently posts an ROIC higher than its cost of capital, meaning it earns more than it spends to fund its operations. This number should also be stable or improving over time and better than what competitors achieve. High ROIC reflects efficiency in converting resources into profit, usually due to factors like pricing power, cost leadership, network effects, or switching costs that keep customers loyal. For instance, companies like Visa and MasterCard maintain very high ROIC because their network-based models allow them to generate new revenue with little extra investment. This kind of business structure is a strong sign of sustainable competitive advantage. Margins are important because they show how much profit a company makes relative to its sales, but they need to be understood carefully. High and steady margins can indicate a company's pricing power, strong brand, cost advantages, or unique products. However, margins alone don't tell the full story. For example, a business that needs a lot of ongoing investment might show high margins, but still deliver poor returns to shareholders. The real sign of competitive advantage is margin resilience. When margins stay strong during downturns, fall less than competitors during price wars, or bounce back quickly after shocks. Luxury brands like LVMH often illustrate this well. Their gross margins are consistently higher than those of mass market brands because their strong brand lets them maintain pricing power, even if the volume of sales changes. This margin strength reflects a genuine competitive edge. Competitive advantage isn't just about making profits. It's also about how much capital you need to earn those profits. Two companies might have the same operating margins, but the one that uses less capital is actually creating more value for shareholders. key financial signs of this include lower net working capital compared to revenue, spending less on capital investments relative to sales, and having higher asset turnover ratios. For instance, software companies with subscription models often have low capital intensity because once the product is developed, adding customers doesn't require much extra investment, allowing profits to grow quickly without needing a lot of new capital. A strong competitive advantage is often reflected in a company's ability to generate free cash flow that is stable and predictable. This means the cash flow generally matches or even surpasses the earnings reported on the income statement, showing consistency between accounting profits and actual cash generated. Companies with real advantages can usually fund their own growth without needing to rely on external loans or equity. In contrast, businesses lacking this edge tend to have cash flows that fluctuate a lot, require ongoing heavy reinvestment, and depend more on raising debt or issuing new shares to keep running. A good example of this is consumer staples firms like Procter & Gamble, which consistently produce reliable free cash flow because of their steady demand, powerful brands, and efficient operations, ensuring both stability and growth over time. A key sign of competitive advantage is how well a company performs across different economic cycles, not just in good times, but also during downturns. Companies with real advantages experience less volatility in earnings compared to their peers, meaning their profits don't swing wildly with changing economic conditions. They also tend to see smaller revenue drops during recessions and recover more quickly afterward. This kind of resilience often comes from structural strengths, like strong customer loyalty, offering essential products, or high switching costs that keep customers from leaving. For example, utilities and regulated infrastructure firms usually show steady earnings because their returns are regulated and they often operate as monopolies, which naturally support stability. These financial indicators together show how competitive advantages create consistency and protect companies from economic ups and downs. Competitive advantage appears in different ways across the three main financial statements. On the income statement, it often shows up as superior margins, stable or rising profitability, and a lower sensitivity to pricing pressures. However, you have to be cautious because accounting choices can sometimes distort these short-term results. The balance sheet provides insight into how efficiently a company uses capital, what its investment needs are, and the intensity of intangible assets. Companies with strong competitive advantages often deliver high returns even with modest asset bases and generate significant intangible value that isn't always reflected on the balance sheet, making them appear asset light and potentially undervalued. The cash flow statement is where competitive advantage is hardest to fake, showing up through high operating cash flows relative to net income, low maintenance capital expenditures, and excess cash available for shareholders. Over time, cash flow provides a reliable picture of true economic value because it is much harder to manipulate than earnings or asset values. Together, these three statements give a comprehensive view of where and how a competitive advantage exists. Understanding how competitive advantage appears in financial statements offers real value to business leaders in several ways. First, it provides a way to validate strategy objectively. For example, if return on invested capital is declining, it could signal that the competitive advantage is weakening, even if revenue is growing. Similarly, if margins are shrinking during growth phases, it may mean differentiation isn't as strong as it once was. This helps leaders move beyond just telling stories and lets them face the economic realities of their business. When it comes to capital allocation, companies with solid competitive advantages should reinvest aggressively when returns are high, avoid investments in lower return areas, and return excess capital when opportunities don't create value. Financial statements provide the evidence needed to make these calls wisely. Lastly, linking performance measurement and incentives to metrics like ROIC, free cash flow, and economic profit encourages management to focus on sustaining competitive advantage instead of pursuing short-term growth that might harm long-term value. This approach helps align decision-making with what really drives lasting success. Start by calculating the return on invested capital, or ROIC, over a period of 5 to 10 years to see if the company consistently generates value. Pay attention to how steady and resilient these returns are, especially during difficult times, since a true competitive advantage tends to hold up under pressure. Compare the ROIC to the company's cost of capital. If ROIC regularly exceeds this cost, it indicates economic profit, which is a crucial sign of a lasting advantage. Next, analyze the stability of profit margins, focusing on whether they remain firm even when the market faces challenges. Look at capital intensity to understand how much reinvestment is necessary for growth, since a company that achieves growth with less capital is often more efficient. Then evaluate cash flow quality to confirm if profits are actually converting into cash, as this demonstrates financial health and sustainability. Finally, always benchmark these metrics against peers. Because competitive advantage is relative, it's about how a company performs compared to others in the same industry. This step-by-step approach gives a clear picture of where a company truly stands over time. Apple's competitive advantage shows up clearly in its financials, with high gross margins that come from its strong brand and integrated ecosystem. The company generates exceptional free cash flow, which supports growth and investment. Despite its large size, Apple maintains a strong return on invested capital, proving its efficiency. What's key is that Apple doesn't just grow revenue, it effectively monetizes customer loyalty and pricing power. Amazon, on the other hand, is more complex. Its retail business operates on thin margins and is capital intensive, but its Amazon Web Services segment stands out as a strong source of competitive advantage, thanks to high margins, strong ROIC, and scalable infrastructure. This contrast highlights why looking at segment-level performance is important. The airline industry provides a useful counterexample. Despite well-known brands and strong operations, airlines consistently show return on invested capital below their cost of capital, face high capital intensity, and endure relentless price competition. These numbers reveal lack of sustainable competitive advantage despite surface success. Financial statements offer several clear benefits when identifying competitive advantages. They provide objective, measurable data that can be compared across different time periods and among competitors. Since these statements are directly connected to shareholder value, they offer relevant insights into a company's financial health and performance. Additionally, it's more difficult to manipulate these numbers consistently over long periods, which adds reliability. However, there are limitations to keep in mind. Accounting practices can sometimes distort the real picture, especially when intangible assets are written off instead of capitalized. Short-term financial data might also overlook long-term advantages, and unexpected external shocks can temporarily skew results. Because of these factors, it's important to combine financial analysis with a deeper strategic understanding to get a complete view, rather than relying on the numbers alone. Competitive advantage is not just a story companies tell, but something that shows up clearly through economic results. When a company has a real and lasting advantage, it demonstrates this through strong returns on capital, consistent cash flow, efficient use of assets, and resilience even during tough times. For investors, digging into financial statements provides a clear way to tell the difference between real competitive moats and marketing hype. For business leaders, these numbers are an honest report card that shows whether the strategy is truly effective. In the end, creating value for shareholders isn't about ambition or growth alone. It's about maintaining a sustained economic advantage, and that advantage will always reveal itself through the financial performance over time. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.